Good morning. Hope everybody's doing well on this Saturday. We're back at doing some of these coffees with Kirk, and I think what I'm going to do going forward is just the first and third Saturday might be easy to remember for everybody, and then we'll cut it back a little bit to just reduce a little bit of the amount of preparation, stuff like that. We've gone through a lot, and we'll just continue to update stuff. But today, I just want to talk a little bit, just a couple topics. Get a lot of questions on, the big tech stocks, the ones that have been driving the markets. It's like, why aren't we just all invested in that? And wanted to kind of put it in a little bit of historical perspective, and then kind of talk about, I kind of seen a shift in what the markets are doing right now, and just wanted to kind of talk briefly about that, and then just open up the questions. And that's really the big thing is having this thing go to questions. So I will jump into the presentation, and we'll go from there. So specifically what I'm going to look at is, what they call sort of the FANG stocks. Everybody's probably heard of this: Facebook, Amazon, Alphabet, which is the name for Google, Apple, Netflix. Those stocks have done very well the past few years. And, we can go back and compare it to the 2000 market situation, when the internet bubble burst. But I think there's kind of a better parallel when you look at something called the Nifty 50. Some of you may be old enough to remember that from the 60s and early 70s, but we'll talk about that. And then secondly, the big thing is you kind of start to see a little bit of a shift in what's happening in the markets. Kind of a inflationary move is really coming on. I've been talking about for a while the battle that we're going to see between deflation and inflation. So essentially the market, not just the market, but the economy in general, wants to deflate. It's got an environment that is normally, if it was left alone, would just deflate. We have way too much debt. We have pretty much overextended stock, bond, real estate market as far as prices. All of that stuff typically would deflate if left its own functioning. But then on the other side, you have the central banks around the world, the Federal Reserve here in the US, the ECB in Europe, Japan Central Bank, and they are absolutely trying to keep deflation from happening. They want inflation. So they are going to just battle for the next few years. And I think it's going to be an ebb and flow situation, because if the natural tendency is for things to deflate, and then the Fed has to step in to stop that, so you're probably going to have kind of an accordion economy. So you're going to have a period where the central banks think they're winning and they sort of relax a little bit, and then the natural forces of deflation are going to come back in. It's going to be back and forth. And I think ultimately inflation is going to win, only because it's pretty clear now the Federal Reserve and the other central banks around the world are going to they're just going to print money. They're not going to let anybody experience pain, or try not to. But it's going to be a process with that. So anyway, let's just jump into the technology part of it. Technology is certainly a great business model because it's highly scalable. Everything you do with technology, if you write a software program, you could sell it to one person or 1 million people without a lot of extra effort. Whereas with an automobile, producing an actual computer, a lot of different things, clothing, you've got to produce that stuff 1 million times over. Now, you can certainly get efficiencies within the production, but you still have to produce those things. It's not nearly as scalable. So technology is always a very good business model. And you typically see higher profit margins with technology. Now, the other thing you have to remember, though, with technology on the flip side is it's much easier to get into it. I'm not going to be able to build a new automobile manufacturing plant. I mean, that takes a lot of capacity. But you know what? I could put an app together pretty easily that could compete with some other software that's out there. So there's a very low barrier to entry. But you know, typically what you see is with any normal functioning economy, you're going to have all different industries producing or being a big part of what's happening in the economy. But we're seeing technology just really grow beyond what it normally should. This chart kind of gives you an idea, you know, dating back to the tech bubble of 2000, just the percentage of the total stock market that technology makes up. And I mean, you can kind of see we're sort of at the peak there again that we saw back in 2000. So it's really just making up an enormous amount of the stock market capitalization. Specifically, you know, I always, again, the FANG stocks, the big ones, Microsoft, Apple, Amazon, Alphabet, which is Google, and then Facebook. You could even throw Netflix in there and bump it up even more. But just those 5 stocks alone make up more than 20% of the S&P 500. That's not good. That's a pretty dangerous trend in the market. They have 5 companies that are over 20%. And you can go back, look at 2000 peak when we had the top 5 stocks: Microsoft, GE, Cisco, Intel, Walmart. You know, at that point, they were making about 18% of the S&P 500. And if you go back and look at the charts for those companies from 2000 really until about 2010, not really good performance. In fact, pretty bad performance. This is just another graph to give you an idea of the dominance of those stocks. This is the S&P 500 by weight. And there's a lot of great stocks and great companies that are within all the noise there. So it just kind of puts into perspective how big these have come. Are these great companies? Yeah. I mean, Microsoft, Apple, Amazon, I mean, they're all fantastic companies. But, you know, do they deserve to be that big of the total stock market pie? Historically, not really. This also gives you a little bit of an idea of what the stocks, the FANG stocks have done as far as performance. And really, when you take out those stocks from the year, you know, the market's not doing very well at all. They are just producing so much of the market returns, and they have been for the past couple of years. Apple had really good numbers just released a couple of days ago, but the valuations are still just extremely high. I've shown this graph about a month ago, I think it was. And it just gives you an idea basically of the price to earnings over the past 5 years in the orange line, and then the enterprise value relative to earnings before interest, taxes, depreciation, amortization. So basically the value of the company. And you can kind of see it's, you know, even for Apple, it's really high relative to its own historical norm. And Apple does deserve a premium. I'm not trying to say that they don't deserve a premium. They're a fantastic company. But even when you look at it historically, its valuation, it's very richly valued. This was just another kind of graph to give you, going back to 1980, the start of each decade, kind of what the trend was going to be and what the top companies were. And you can see from decade to decade, this changes quite a bit. Peak oil in 1980, outside of IBM and AT&T, it was basically oil companies that were, you know, dominating the top 10 companies. And then, of course, in 1990, just as the Japanese stock market was peaking, you can see so many of the companies in the top 10 were Japanese companies. 2000, we had the bubble. So we had a lot of companies that were focused in on tech. So Microsoft, Cisco, Intel, Lucent, you know, Lucent's been broken up and just got destroyed. The others are at least still around and doing well. But all of those companies had struggles. 2010 was kind of the the China takeover. So it went from Japan in 1990 to 2010. China was going to take over. You can start to see how things look there. But then 2020, right now, the thought in the the finance world is you got to just be in the FANG stocks. And this is what it looks like. So even the ones after Microsoft, Apple, Amazon, Google, Facebook, we have Alibaba and Tencent, which are also technology companies, but they're Chinese based. So it's going to be interesting. We'll see. You can at least take from this chart that 10 years from now, when 2030 rolls around, it's probably very different. You're not going to see these same companies up there. So how does that play out? And one company in particular that just amazes me. So many people love it. So many people want to invest in it. Again, great company, but is it worth the price? And this one's probably the most egregious example, in my opinion, of what's going on with some of these tech stocks. It's Tesla. So Tesla right now, it's unbelievable. You could basically take Toyota, GM, and Ford, wrap it all together, and Tesla is still worth more than they are. This chart just gives you an idea relative to Toyota, what the company is valued at. So, Toyota has 19.3 billion in profit. That's profit. Tesla has 24 billion in revenue. So that's before revenues, before all the expenses. So 5 billion more in revenue as compared to just the profits from Toyota. And then you look at the number of cars that they produce in a given year. I mean, you're talking, it's 2.4 million. This might be for a quarter, actually. I think it is. I mean, but they have 8% of what Toyota does. Now, a lot of people will argue, well, it's because they have great technology. Okay, yeah, their EV technology is better than most companies. Okay, I'll give you that. Is it worth that kind of premium? The second thing is they say, well, they do solar panels. They're not just a car company. They're really a technology company. Even if at a technology company, is it worth the valuation? I just don't see it. It's just amazing to me that the markets would start to price things like that. And the thing is, it's not like they're really seeing a huge increase in their production on the cars. You can kind of see after 2018, but since mid 2018, their quarterly deliveries, their quarterly output of cars hasn't really gone up. I mean, you would want to see just straight out upward climb in order to say, okay, well, they're going to actually be able to at least grow into the valuation. I don't even see that, quite frankly. But like I said, they're right now more valuable than Toyota, Ford, and GM combined. And the way you have to look at it, I mean, when you buy a stock, you have to look at it as if you're buying a local company. If you're going to take your own capital, I mean, if you're going to come and buy my company, let's say, would you pay the same amount of price or more than if you were buying Merrill Lynch? Merrill Lynch has offices throughout the country. They're way bigger than I am. But essentially what you're doing in the situation by Tesla is you're saying, I'd rather own the small company rather than the big, well-developed company. Now, granted, they're more technologically advanced. They can be more nimble, but still, I mean, if you were going to take your own capital out of your pocket, out of your bank account, and buy a company, how would you justify buying Tesla where it's at, as opposed to taking your same capital and you can buy Toyota, Ford, and GM? I just don't see it. And even they had a quarterly profit just released here. They had $100 million profit this quarter, but of course they cut their research and development the same quarter by $100 million. I mean, that's not real good. They also had $400 million in government credits. So if you take that away, I mean, they're very unprofitable. And if they kept their R&D up, that's a $500 million swing there. And just to get to any kind of reasonable, barely reasonable valuation for their stock price, they need to have about 20 billion in profits. Again, they had 100 million. So, you'd want to see just massive rapid growth like this. Now, if they truly were a technology company, maybe they could do it. Maybe they could add 1 million users every quarter. Like Netflix draws in, it's still not profitable. At least, it's drawing in a lot of new people without much effort. You can't do that with Tesla. You've got to build the car. It is a very labor and capital intensive industry. So I don't buy the whole it's a tech company, because they can't scale like a tech company. So anyway, going back, I mentioned I wanted to kind of compare. I think we can always go back to 2000 and talk about the internet bubble and then compare the stocks today. But I think there's a better comparison, and it goes back to the Nifty 50. So all the way through the 1960s and then to the early 70s, there were 50 U.S. companies that basically Wall Street said, you just buy it. You don't think about it. It doesn't matter what the valuation is. It doesn't matter what's going on. You buy these companies. They're phenomenal companies. They're not going to do anything but go up. And again, they're all really good companies. Everybody in that Nifty 50 was a fantastic company. But a fantastic company doesn't always make for a fantastic investment. And the reason I say that, it just kind of gives you an idea here. Looking at some of the cheapest of the Nifty 50 stocks from back then and the most expensive. Most of these stocks peaked out in 1972, as did the stock market overall. But it kind of gives you an idea of how expensive these things got, and also what the future 10-year returns. And that's really want to focus on. So some of the stocks, at the top, the cheap ones, yeah, they're overvalued, but they weren't. I don't think they were egregiously overvalued. Philip Morris, which, Marlboro, they were at 25. Bristol Myers and Pfizer were under 30. So was Pepsi, Dow Chemical, Procter & Gamble, IBM, great companies. But 37 was the highest price to earnings. And again, the price to earnings is just take the price of the stock, divide it by their earnings per share, and then you get that number. But then they had some that were really expensive. They kind of got to really high levels, not quite like the technology stocks today. I mean, Amazon's at 2,500 free cash flow, over 260 price to earnings. To give you an idea, that's Amazon. These companies, the expensive Nifty 50, like McDonald's, Walt Disney, Johnson & Johnson, Coca Cola, you're looking 50 or higher on their starting price to earnings. And then what did that mean for the next 10 years as far as investments for these companies? Well, you can see for the most part, pretty negative. I mean, there were some that were positive with the lower P&E, some of the cheaper Nifty 50s, but pretty much the expensive ones, you weren't going to get much of a return over the ensuing 10 years. Now, when you get out to 20-year, 30-year, 40-year, pretty good returns. But what you have to realize is that over the pretty, midterm, 10-year, 15-year, the great companies that are at extremely high valuations typically don't produce very good returns. And like I just mentioned, the tech stocks, if you take these expensive Nifty 50, these tech stocks are even higher as far as valuations. So, it's just kind of to be a little bit of a warning, just to put things into graphical experience here. This gives you an idea from that 1972 peak, how long it took some of these companies to get back to where they were. So not only did you have kind of a negative annualized 10-year return for some of these companies, but essentially what you had was a negative return for a long time. This was Xerox. It took them 24 years from the 1972 period to get back to break even. This is Walt Disney. It took 13 years. Coca Cola, it took 12 years for them. Same for McDonald's. Took them 12 years to get back to break even from their peak. And then General Electric was 10 years to get there. And GE was a monster back then. Now it's probably going to go out of business. But back then it was the company. So that just kind of gives just a fair warning on this. I know a lot of people like to, in their, some people in their personal accounts, or a lot of young people especially, just loading into these things. Be careful, because, when they finally do turn, it doesn't usually turn that slowly. It's not as easy to get out as what people would think. So that's on the tech stocks. I just want to talk a little bit about that because I get a lot of questions on it. Should we buy Amazon? Should we buy Tesla? Tesla's one I get a lot. And I just can't, I can't do it. I mean, you're speculating. You're just hoping it continues to go up so you can sell it to another sucker. That's really not investing. So this is a graph kind of shifting gears to talk about a little bit bigger picture here right now. This was a graph I used, or I showed you that I use to kind of where are we at economically. And it kind of gives this idea. So for most of this year, we've been in what we call quad 4, which is a deflationary environment. You have slowing growth, inflation is decelerating, and the monetary policy is very dovish. So they're meaning they're putting a lot of money in. The ideal place to be is in quad 1 or 2. Those are where you really like to be overall economically, and then as an investor. Quad 1 is Goldilocks, and that's probably the best one because you've got growth, you've got slowing inflation, and then kind of a neutral monetary policy. So they're not printing too much, but they're not too tight on monetary policy. Quad 2 is pretty good reflation, accelerating growth. You've got inflation kicking in, but the monetary policy is trying to slow the inflation. So you typically, it's a pretty good place to be. Quad 3 is kind of where I think we're at right now. So that's sort of a stagnation or stagflation. So you still have growth slowing for the most part. I mean, we are coming up from where the huge drop, but on a year-to-year comparison, we're still slowing. Inflation is now starting to accelerate, and we'll talk about that. I'm starting to see real weakness in the dollar, and that is causing some inflationary things with commodities, but we'll talk about it in just a second. Monetary policy is typically neutral there. Right now, we actually have very dovish, so there's a lot of monetary policy coming out, which is actually fueling the inflation portion. So it does shift a little bit about how we want to think about investing. So again, the dollar, we've been talking all along, watch the dollar. The dollar is going to be a big factor in the investing landscape. So when you have a strong dollar, that's probably not going to be good for international stocks. It's not going to be good for commodities. It's good for you as an individual, I think, because it costs less to go to the pump, less to go to the grocery store. You have a sort of a cap on, price inflation, but the dollar's sort of broken down. You can kind of see in March and April, it sort of peaked and stayed above 100 for quite a while, had a pretty good drop in June, but then sort of stabilized, but now it's steadily losing value again. And this is a very busy graph. It just looks at each of the 4 quads and sort of what's good to be invested in. So again, I think we're heading into quad 3. The green things are what you kind of want to invest in, whereas the red things are items that you want to avoid. So right now, utilities, real estate, energy, which is sort of a commodity play. Now it says technology. I'm not really looking to do tech, but that typically does well in a stagnation or stagflation environment. As far as bonds, you do actually want to have inflation-protected bonds, TIPS, and long-duration treasuries are also very good. Municipal bonds, if you have taxable accounts, are going to be good. But you do want a lot of high-quality stuff in quad 3. This is just a graph that kind of shows you another period where we had really a weak dollar for an extended period of time. I don't know if we'll have an extended period of time for a weak dollar. Again, I think we'll have that yin and yang between deflation and inflation. So you can see the dollar kind of drop, and then you can also probably see it start to rally again, depending on what goes on in the world. So it's going to be a little more flexible. But this was looking at basically a decade-long dollar decline. So if you looked at a chart over a decade, you had, while you certainly had cycles within that, you had a longer-term trend. And within these, what you're going to see is things like commodities, emerging markets. Emerging market stocks do well in this kind of environment, mainly because they're commodity producing. Most of these countries are still at the point where they're producing oil, foodstuffs, things like that. You're talking Brazil, a lot of South America, Eastern Europe. So a lot of intensive commodity economies. So that's probably why they do well. But value has done well in these things. So value versus growth, typically value might do well in that. So this is just a listing of some of the inflationary assets that do okay. Tips, I'm going to be adding a little bit more to tips. Always had a little bit in there, but for clients, we're going to add more to inflation protected bonds. Also long dated. We're going to keep our long dated bonds because they tend to do well here for initially, unless it really becomes a longer term trend for the dollar. Gold and any kind of commodities are going to do really well here. And we'll take a look at that in a second. But we're starting to see gold and commodities and silver really pick up. Same with, we talked about Bitcoin in the past. It's something to think about. I haven't started allocating that to clients yet. There's really not a SEC approved investment to do it, but I'm looking at strategies to try to help some folks get into some Bitcoin. But all of those are doing much better. You also kind of want to get into U.S. cyclicals versus U.S. defensive things. But the big thing here is looking at, commodities. That's the big thing. Some inflation protection for bonds, which would be tips. And then just to give you an idea, not only is it just the dollar that's providing a little bit of tailwind for these assets, we also have some longer term cycles that I think bode well. Everything in life is cyclical. Everything is cyclical. And what this does is it compares the S&P Goldman Sachs Commodity Index, that's GSCI, so Goldman Sachs Commodity Index, divided by the S&P 500. So this is essentially looking at commodities divided by stocks. And it gives you sort of a trend of what you're going to see. So the bottom, when commodities were really cheap, previously, it was the post-war boom back in 1966 to 70, and then the tech bubble in 2000. Those were great times to kind of allocate more to commodity than stocks. Not to get out of stocks by any stretch of the imagination, but start to put more into commodities, which is not a natural thing you see in most people's portfolios. Now, there's periods where we sort of spiked mostly when oil did really well, the biggest commodity. It's the most liquid of all the commodity markets. So the oil crisis of 73, 74, obviously we saw commodity prices high then, mainly oil and natural gas, but the others were also pretty high up there because it was an inflationary environment. The Gulf War, again, oil spiked. And then actually even the financial crisis of 2008, at that point, you saw a pretty high price in many commodities. I think you might remember the price of oil going up well over $100 a barrel, which probably helped push us into that recession just because the cost of production and transportation went up so much. But other commodities at that time are also high. So right now, commodities are extremely undervalued, probably the most undervalued they've ever been relative to the stock market. So just the longer term cyclical trend there is favorable for commodities. And then when you have a weakening dollar, that also tends to do pretty well. And this one looks at gold versus the stock market. So here again, you can kind of see, when gold was doing great back in 2010, 2011, when it peaked at $1,900 per ounce in 2011, that was the bottom of the gold versus stock market. So stocks clearly did much better over the ensuing 7 or 8 years. But we've kind of hit a point now where it feels like gold relative stock is shifting again. And we're thinking, maybe the beginning of 2019 was sort of the peak for the gold versus stock ratio. So since then, gold has outperformed the stock market. And it just seems like there's more room to go, again, on a kind of bigger term cyclical. Throw in a weakening dollar, it's definitely going to happen, probably. I shouldn't say definitely. This is just a recent chart year to date of commodities. So what this thing tracks is the 24 24 commodities. So it's got oil, natural gas, it's got all the grains, it's got industrial metals, precious metals, and it's got livestock. So it basically represents the entire commodity landscape as far as the investments. Now, they got just hammered in the January through April period. A lot of, again, price of oil being the largest commodity, but really everything was dropping at that point. A lot of it because the dollar was becoming so strong. But since then, what we've seen is kind of a pretty solid rally back for commodities, and it seems to be accelerating since June. So commodities are definitely something that's starting to pick up, all of them. And then, of course, this is the price of gold. You can see gold is essentially, except for a small period in early March, it has just been nothing but a march up. And it's really starting to pull away from its technical indicators. And then the one that's really jumped recently is silver. Silver is an interesting investment. Silver is something that it's always a tail risk. It doesn't, a normal investment, you have the bell curve. Most things, if you look at the stock market, most things fall within that bell curve. Silver is something that has huge tail risk. So the tails are actually higher than the middles. So it's something that it goes nowhere for a long, long time. And then it just explodes either up or down. It's an interesting dynamic to it. It doesn't typically have the normal bell curve investment landscape that you see from other investments. So right now it seems to be that tail risk up, it's going to move. And when these things move, they tend to really fly. So, it's up from the bottom, it's up over 50%, but even just for the year, it's up over 20%. And most of that has happened in the month of July. So silver, I think there's some room on the tail risk, that move up to add a little bit to silver. It's not really, silver has changed quite a bit. It's not purely the precious metals like gold is. It still is seen that way a little bit, but it is a very industrial metal as well. So if you don't have a lot of industrial use, silver can kind of just flatline even if gold's doing well. So, looking at adding some of that there. Again, I got to throw this out here in case anybody who's not a client sees it. Have to make sure, do not use this as investment advice. I did the best I could to put together the slides, yada, yada. Okay. So we'll jump into some questions then. Okay. So one question, what are you investing in? So some moves I'm going to make for clients is kind of move into a quad 3. So in the fixed income, we'll still have a lot with, treasuries. We're going to have the high quality treasuries, probably longer dated stuff for right now. And then I'm going to add more to inflation protected treasuries. That'll just, and the way tips work, a lot of times people understand how inflation protected bonds work. A normal bond, you give 10,000 to the government, the corporation, and then they pay you an interest rate for that. So if you get 4% on 10,000, you're going to get that 4% yield, and that's it. With a tip, what happens is you give them 10,000 and you might only get a 2% yield. But what happens is that 10,000 you initially loan them will adjust each year by the rate of inflation. So that's how it kind of gives you some inflation protection. So we're going to add some tips. We're going to add precious metals, a little bit more. We've already got some, but gold and silver specifically. We're going to add commodities in there, some emerging market equities, so some stock on that end. We're going to stay, with some utilities in stocks. That's a good place to stay. And then we'll probably also add a little bit more just general international, but focus on the emerging markets. So that's kind of some of the new changes we'll see happening. What's the outlook for small cap and value stocks? Great question. So I think value stocks, my next presentation in 2 weeks, I'm going to focus on growth versus value, sort of a play off of the technology that we've already talked about. But we're also seeing a historical, record deviation between growth and value. So growth stocks, again, fast-growing companies, technology-laden. Value stocks, typically slower movers, or they've been companies that have been beaten down. They're going to kind of move back. And then oftentimes high dividend paying, just things like that. But I'm stealing my thunder from a couple of weeks from now. But essentially, value is at levels that we haven't seen since 2000. So there's some really good opportunities with value stocks if the markets eventually figure that out. Right now, it's all let's buy the fangs, but that stuff starts to turn, and when it does, it turns pretty quickly. Small cap is a little bit different because small cap is really tied to the economy. Whereas a 3M, a huge PepsiCo, things like that. Yeah, they're tied to the economy, but they're very diversified. They're very big, but a small company stock is really, really tied to what's going on. And the economy is still very suspect. So I'm not as big on the small caps right now. I just don't think that they offer compelling value. I don't see it. Would you buy the QQQ? Tech stocks have done well this year, but I don't know if I'd necessarily buy it at this point. I wouldn't add any money to it. I wouldn't necessarily sell it if you have some, but I wouldn't add money to QQQ, which is the NASDAQ 100. Now, maybe short term, it could still do very well, but the valuations are really high. And again, the economy just hasn't really come back like people are hoping. It just hasn't. So all of that's going to start to play in. What usually ends up happening, the way the growth of value sort of normalizes, is if the economy doesn't come back, at some point people are going to look at valuations and say, hey, there's more compelling value in some of the more boring companies, some of the value companies, and that could hurt the Qs. But who knows, right? Would you buy banks? Ooh, good question. I was actually going to talk about that in 2 weeks. No, I wouldn't buy banks, not in this environment yet. Mainly because what we're seeing is, despite the fact that I think we're in an inflationary environment, the commodities are saying that, the dollar is saying that. If you look at bond yields, they're still going down. They're coming down. And we could get to the point. There's a lot of people say right now that the bond market is telling the stock market there's trouble ahead because bond yields are coming down. So if bond yields continue to decline, that's not good for banks. Banks need a market where the very short term, where they can borrow from the Fed, where that's very low, and then the 5-10 years, they want a normal curve up so that they can lend out. If they're going to lend out for 30 years for a mortgage, they need to make sure that there's a gap between what they borrow the money at or what they're giving in the deposits. If they're giving deposits of 1% to everybody who puts money in the bank, they want to make sure they're getting 5% on that mortgage or some sort of float that's going to be good. But when longer term trends are coming down to the point where there's not that much of a spread between the short term, what they're giving to people in deposits, and then what they're loaning at, that's a pretty dangerous time for banks. So I probably wouldn't go into finance at this point. Inflation is also not very good for banks. So if we truly are in an inflationary period, that's not going to be good. So I think banks are getting hit from both sides right now. So normally inflation, you see bond yields go up, but we're not seeing that. And then inflation hurts them because they lend out for long term, and that inflation eats away at their profit margin. So it's kind of a double whammy right now for banks. What do you recommend buying right now if I have $2,000? Well, that's hard to say. That is it only 2,000 total? That's all you have, or is 2,000 just the money you're ready to put in, but you have another $500,000 in investments? big difference. If all you have is 2,000, I'd probably just put it in emergency savings. Make sure you had that. If you were going to invest it, and that's like, okay, this is what my investments are for the year, I'd probably split it up. I'd put, again, I don't know your risk tolerance or anything like that. So put a little bit in commodities, a little bit into just the general total stock market, probably 50% there. So 25% in each, and then put the rest into bonds. You just sort of hedge yourself. But that's a hard question because I don't know your personal situation. And again, remember my disclaimer, don't take this as advice. It's just an idea. But I would definitely add some to some commodities right now, and then have some stocks, and then put some in bonds. So let's see, any other questions? I don't see any right now. Okay, great. So again, we're going to go to the first and third of every month. And one more question came in. Would you buy Chevron or other oil stocks? Yeah, I mean, oil stocks tend to do well in a quad 3. So, you could look to buy, State Street has a, what is it? What's the ticker? XLE invest in 40 different, energy stocks. So that could be a pretty good investment right now. So I think that would look pretty good. I don't expect the price of oil to go up too much, but, I think it's in this environment, it's probably got some tailwinds to it. So again, basically what I'm looking to do, first and third Saturdays of the month, we'll do these. I'll continue to get you the invites and all that good stuff. Next time we'll talk a little bit more about growth versus value. That'll probably be the big thing. And I'll talk about banks a little bit on that. But whatever question you have, I like to use this. The reason I started doing this is because I was getting a lot of the same questions from folks. So I figured a few questions are coming from clients. Probably everybody has the same questions. So just keep throwing those questions at me. I like to base it on what you want to learn about. And I'm going to start to integrate, we've been doing a lot of investment, a lot of economy stuff. We'll continue to do that, but I'm going to start integrating some more, retirement stuff, some thoughts there, taxes. I think that's going to be a big play, especially, if Biden wins. Right now, it looks like the lead's pretty big for him. I don't want to get into what his tax plan was yet. People have been asking me about that. I don't like to do any of that stuff until something gets passed because it's all conjecture. But anyway, first and third Saturdays, we'll do that. Again, you'll get the replays if you sign up for it that way. I appreciate your time and hope everybody has a great weekend. Take care.